Hi everyone, and thank you for joining us. I know there's some of you that joined us for every single one, this being the last one. Tom and I really appreciate all the support, and we hope that it's been informative over the 5 past webinars. We've chatted about different things such as market volatility, when to invest, looking at market conditions now. Obviously, we looked at industry fees, the one Tom and I did together, comparing different asset classes and just looking at what to look out for when you're making an investment. We also chatted about the process of foreign exchange, a little bit of structuring as well, and then obviously lastly with Jeff last week, looking at different jurisdictions to invest in, what to look out for, which jurisdictions are safe, which are not so much. So obviously all this led to the kind of theme of building a legacy, which is the theme of our webinar series, and we kept the best for last, having one of the directors here from Sovereign, from the Sovereign Group, just chatting to us a little bit about succession planning and the practicalities of passing away. Not always an easy discussion, but a very, very important one. So firstly, thank you, Coreen, for joining us. I know you are very, very busy. So I'll just jump straight into it. I think a question that a lot of people want to know is how long it takes to wind up an estate. And I think it's a question that also catches a lot of people off guard.
Yes, it does, because you will be surprised to know that it can take anything from 5 months to several years. And then I often get the question, well, why will it take so long? And what needs to happen practically is when you've got a nominated executor, they first need to go through what we call the probate process. They need to get permission from the Master's Office, the Master of the High Court, that they are officially the executor of the estate and that the will be regarded as the valid will of the deceased person. And once the executor have been issued with the letters of executorship, they actually start with the dirty work. Then they need to get all the financial information on this deceased person. They need to place certain advertisements in government gazettes and newspapers. If there's international assets, they need to start to liaise with the international executor. And then they need to look at all the costs and the claims that needs to be paid by this estate, which often also involves selling certain assets to raise the cash to be able to pay for the expenses in relation to the estate. And I mean, we know we live in Africa, nothing happens quickly in this country or on this continent.
Tom, you're...
Sorry, Alfonso, you stalled there for a moment.
Tom's your voice. You back, Tom?
Sorry about that. What I was saying is, Coreen, you obviously mentioned that there are various things that need to be paid for in the implications of someone passing away. What are the certain financial implications of this happening? I mean, what are the actual fees that you need to be addressed?
Well, I think we can divide that into 3 categories. You've got your administration costs, you've got your claims against the estate, and then you've got the taxes. I think taxes being the most important probably to be aware of, so we can touch on that. You need to consider capital gains tax. I think what a lot of people don't know is when you pass away, it triggers capital gains tax. So we need to look at the value on the date of the person passing away. Capital gains tax, we have a certain formula that is used to calculate capital gains tax. So at the moment for individuals, it's 40% of the gain would be included in your marginal tax rate. So it's not a 40% tax rate, it's only 40% of the gain will be included in your income, and that will be taxed at marginal rate. And then we have estate duty, 20% on estates above 3.5 million rand. If your estate is worth more than 30 million, we go up to 25% estate duty. And maybe worth mentioning is that we apply the spousal exemption in South Africa, like many other countries, and that just means if the spouse inherits, that there is no estate duty payable. Only when that spouse then passes away, estate duty will be triggered, and we will look at 7 million before estate duty is triggered. Administration costs, that include things like the executive's fees. At the moment, according to the prescribed rate, the maximum rate that an executive can charge is 4.025%. And then what people also forget is that the executor can actually charge fees on the income that he collects after the person has passed away. And that is slightly more, that's 6.9% if we take that into account as well. Then there's smaller fees, the master's office fee needs to be paid, and there's government gazette fees, there's newspaper fees that need to be paid, but that's actually quite minimal. And then you've got the claims against the estate, debtors. Think about divorce orders, maintenance claims that might have to be paid, any debts that the person owed to anyone else, that would have to be taken into account. And then what often happens is that the executor needs to sell assets to be able to pay for these things, because remember, they need to be paid in cash, as the people want the money. And then before he just goes and sells these, he would obviously have a discussion with the beneficiaries, but at the end of the day, the executor, the point that I want to make is that he would have to sell, or if the estate hopefully is cash rich, he can actually use that cash to pay for all the costs associated with winding up the estate.
So naturally, if you're sitting there and the executive decides what gets sold and what has to be obviously put on the market to find quick ways of generating this cash, is it always in the best interest of the estate to have these things sold? And how do they decide which assets go first? I mean, it's very, in a complicated estate, it must be a hard thing to go through.
No, you're exactly right, Tom. If the will didn't provide details around the deceased wishes as to what assets needs to be sold to pay for what expenses, it will be a discussion between the beneficiaries, and if they're in agreement, and I believe they are, they will approach the executor and make recommendations. If they're not in agreement, that is where we actually have a state that can take several years. But ultimately, the decision would lie with the executor as to what gets sold. And I think the risk there is that you often have assets being sold at the wrong time, at the wrong price, or you have sentimental assets, maybe certain jewelry or art, that is going to leave family ownership if you sit with an estate that isn't cash rich.
Okay, so that's with a will, and it sounds complicated. What do you do when there's no will in place and you pass away? How does it work then?
Now, it becomes even more complicated, and it takes even longer to wind up the estate. What then happens is that the beneficiaries or the heirs of that particular estate would come together and they would nominate an appropriate executor. That recommendation would go to the Master of the High Court, and again, you go through the same probate process where the Master of the High Court need to approve the appointment of that person as the executor, and he would issue the letter of executorship. Again, if there's assets internationally, you would also have to recommend and nominate an international executor who also then needs to be approved by the Master of the High Court here in South Africa. And then the executor goes in very much blindly and try and find all the financial assets or all the financial information and the assets to be able to determine how he's now going to wind up this estate. After he's collated all the information, then it's very much restricted by law as to who and how can benefit. And that is determined by interstate succession law, and there's a specific formula. And how it basically works is, if there is a spouse, the spouse will be entitled to benefit from the assets. If there are also children, it would be the spouse as well as the children. If there's no spouse, no children, you go one level up, so you would look to the parents. If there are no surviving parents, you go sideways, you would look at siblings, and that's kind of basically in very broad terms how the interstate succession law will determine who would benefit.
That's very interesting, especially mentioning the international assets part of it, because it's such a big part of our business at this point in time. How does the complexity change when you start to look at having that offshore UK property, as so many South Africans have, or having shares overseas or anything like that?
Yeah, so that is a whole area that we can probably discuss for hours, but I'm going to try and make it as short as I can. And when you start to buy international assets, there are various questions that you need to ask yourself. I think first of all, you need to make sure that you're aware of the taxes that's applicable. Does that country levy capital gains tax for non-residents? And you will be surprised to know that until very recently, the UK didn't have capital gains tax for non-residents who own property In the UK, that unfortunately has changed not too long ago. You need to ask yourself, estate duty. Overseas, they would sometimes call it inheritance tax, but it's the same thing as estate duty here in South Africa. Is there estate duty? Does it only apply to the residents? Does it apply to non-residents? And then how much is it? And at what level does it kick in? So I think the UK, I'm glad that you mentioned the UK, Tom, because it's such an easy example to explain, and it's a popular asset class for South Africans. Now, in the UK, there is a double taxation agreement between South Africa and the UK, which is useful. It gives the taxing rights to the UK when it comes to immovable property or insiders' assets. So that would also be company shares, for example. Now, in the UK, inheritance tax is 40%. So it's double the rate that it is in South Africa. And their threshold, it is £325,000. So it kicks in on assets worth £325,000. So if you've got a student apartment or you've got a UK house and the value is below £325,000, then there is an estate duty or inheritance tax in the UK. But if it's over that, then you're going to be liable for 40% only on the value above the £325,000. And then the UK also have the spousal exemption like we have in South Africa. So if your spouse inherits the property or the shares, then there is no inheritance tax. It will only be when they reach their estate, or when the value of the estate reaches £650,000 and that spouse, the surviving spouse, also pass away, that it would be applicable. I think worth mentioning here is just that, remember that offshore trusts don't protect against UK inheritance tax. And so if there is anyone who is owning their property through an offshore trust, you need to talk to Carrick or you need to talk to Asset Sovereign Trust, because that is not going to protect you against inheritance tax in the UK. And I think the other interesting questions to ask is, if you've got property elsewhere in Europe, they've got things, the concept of forced heirship. It's a civil law country thing, or some of the Islamic countries also have it. And that actually just means that you don't have control over who inherits from your estate or part of your estate. So you might be surprised to know that we have it in Portugal. I think that's quite popular among the South Africans. And we have it in Spain, we have it in France, Italy has got it. And half of your estate needs to go to a spouse and children. So even if you have a will and you're a national of that country, their laws will override what is in your will. Now, what's also interesting is, obviously, there's lots of international investors. So if a South African were to buy property in Portugal, I'm just going to use the Portugal example, the laws of where you are a national of will apply. So because South Africa, we don't have forced heirship rules, forced heirship rules won't override the will of a South African. But be careful when you do become a Portuguese national, which is the aim of many South Africans who obtain the residency on that side. They actually, down the line, they do want to become Portuguese nationals. They must bear in mind that forced heirship might apply to their estates on that side.
That's very interesting. I mean, as a South African, I've also seen so many people look at that Portugal residency-based campaign, and I'm sure lots of places in Europe actually have similar rules and so on. I mean, it's a crazy thing to consider. But I know you briefly mentioned about holding UK property in trusts and so on. I mean, I know it's not saying it can actually work, but knowing about trusts and knowing that South Africans in the past, maybe not so much recently, have made use of trusts a lot to clean up estates. Can, say, a South African trust own a property overseas, or what are the certain differences between local and offshore trusts? I mean, what is the difference in owning one and the different ones?
All right, so I think I'm going to just backtrack and answer your first question about, can a South African trust own property offshore? The answer is no. A South African trust can actually not own anything outside of South Africa, and it's purely because our Reserve Bank don't allow for it. Our exchange control rule says no. So if you want to buy property or invest offshore and you would like to do that through a trust, you're forced to set up an international trust. Now, South African trusts and offshore trusts are very similar, but they are also very different. In South Africa, you would have the settler. We use different terminology sometimes, the founder or the donor. That's the person who settles the trust. In South Africa, nominal amount is loan account, Section 70 nowadays need to be taken into account. Offshore, it's much more about transfer pricing. It's slightly different, but practically it comes down to the same thing. So you also loan after you settle the nominal amount into your trust, you would loan the balance in to avoid donation tax. You have beneficiaries with an offshore trust, similar to a South African trust, often the settler and the family. And then you have the tax rates, which is the big difference. South Africa, the trusts pay a high rate of tax. Offshore, it's usually set up in places like Mauritius, Isle of Man, Guernsey. If you're not a resident of those islands or jurisdictions, the trusts don't pay any tax. So there's obviously a big tax advantage when you go offshore, when you set up a trust and you structure it correctly. The big difference for me is not so much the tax, but it's around the trusteeship. In South Africa, the settler is usually a trustee, spouse is a trustee, maybe business partners, a trusted family lawyer, accountant or auditor are the trustees. Offshore, you usually have regulated companies that hold a financial type of license, a fiduciary license to act in the capacity of trustee. So it's not the settler that is on the board of trustees with offshore trusts. There's also this concept of a protector that you have offshore, and many South African clients choose to appoint a protector, or they would want the trustees to appoint a protector to their offshore trust. We don't have a protector, or that concept in South African law hasn't developed yet, and I'm not sure if it is actually the plan to develop it. But offshore, you can appoint a protector. It can't be the settler, because you want to show that the settler is giving up control. But the protector would be your family lawyer or the accountant, someone that's close to the family and that under the right circumstances will veto the powers or the decisions that the offshore trustees has made. So it gives the settler a sense of control without having the control himself.
That makes a lot of sense. One thing that I think I picked up that you also mentioned is that locally, the settler of the trust also is the trustee. What kind of risk does that pose?
All right, so that becomes quite academical, and us tax people get very excited about academical arguments. But I'm going to try and keep this interesting by explaining or mentioning one of the cases, court cases that we actually dealt with. Anyone who has studied law, they might remember the case of Badenhorst versus Badenhorst. And the concept that was made very clear there was, what is a sham trust and what is an alter ego? And what are the ramifications when we are actually dealing with the alter ego trust? So a sham trust, just to maybe before we go into this particular court case, a sham trust is when it actually doesn't come into existence. Alter ego is where you have a trust that legally came into existence, but the trustee is dealing with the trust as if it's still his own asset. So one needs to understand that a trust is, what is a trust? So a trust is when you have your settler that owns an asset now, is giving it to the trustees who become the legal owners of that asset. And they control and manage it for the benefit of the beneficiaries, not for the benefit of the settler, for the benefit of all the beneficiaries. And that may or may not include the settler as well. In most of the South African trusts, the settler is also a beneficiary. Now, what happened in Badenhorst versus Badenhorst, in the early 80s, you had this young couple, 20 and 23 years old, and everything was going well for them. They fell in love, they got married, they lived on this beautiful farm in Swellendam, and before they knew it, the dad said, I'm ready to retire, and young Mr. Badenhorst Jr., he inherited this beautiful farm in Swellendam, and everything went well on the farm. Mrs. Badenhorst, she had a side business on the farm, and she did the farm's bookkeeping, and they had lots of babies, and they were really, life was just going really, really well for them until one day. A court case obviously doesn't go into a lot of detail why they fell out of love, and it might be because Mr. Badenhorst spent too much time playing tennis, or Mrs. Badenhorst, she spent too much time with the horses, or I think maybe it had to do with Mr. Badenhorst having a female fishing partner there in Witstrand. But obviously the court case is not focusing on that, and that's besides the point. But when Mrs. Badenhorst decided that she wanted to get a divorce, she wanted to have her fair share of the farm that was in a trust, and the holiday house was in a trust, and the share portfolios were in a trust. So she used the argument of Mr. Badenhorst Jr. being the alter ego, or the trust being the alter ego of him, because he managed and controlled that farm as if he was the sole owner. He made decisions without consulting with the trustees first. The other trustees were never informed beforehand. Decisions were made and actions were taken. And it ended up in the Supreme Court of Appeal, and she actually had the right to some of the assets that were in this trust. And whether that was right or fair or unfair, that's not for us to decide. But I think that the point to make here is that it can have devastating implications for any estate plan. If a trust fails based on the fact that it maybe was a sham trust, there wasn't the real intention to hand over control. On paper, it looks like the asset was transferred, or the alter ego where you have given up that control. You maybe had the intention to give up the control, but unfortunately, as one of the trustees, you handled it as if it was still your own asset and you had the only say. So I think, yeah, be careful, and that is when it comes to offshore trust. I think it's because the South African settler is not a trustee, it's much harder to use that argument when it comes to offshore trusts compared to onshore trusts. And that's why you would see with many onshore trusts, you now have the concept of an independent trustee. I think since 2017, it's actually a local requirement that you need to have an independent trustee on the board of a local trust.
That's very interesting. And I think, I mean, I'm sure that happens more often than we would like to admit, especially in South Africa, especially the old age trusts that we have here. But maybe to take a step back and bring it back to the actual discussion that we're having here, is maybe to ask you the question, Coreen, is what does proper estate planning actually look like from a citizen?
So for me, it consists of three things. It's creating a valid will. So you need to make sure what are the requirements in South Africa to prepare a valid will. It's detailed financial planning. It involves ensuring that there's sufficient income in the event that you can't work. It's ensuring that there's sufficient cash in your estate now during your lifetime, but also in the event of death. And that's where life insurance policies sometimes become quite useful. And then it's intelligent tax planning. You want to ensure that your estate at all times are cash rich so that it can pay for any liabilities, any claims that arise, so that you don't run that risk where the executor needs to sell assets which are maybe sentimental to the family or selling at the wrong time, wrong price. You want to ensure that there's cash available to pay for these and that you can actually just leave a legacy.
I mean, that all makes a lot of sense, but at the end of the day, how do you go about doing something like that? Minimizing your taxes, obviously, to create and even protect your intergenerational wealth. I mean, that at the end of the day is the theme of the whole webinar series. So how do you go about that?
So I think it's sitting with financial advisors who are experienced. You need to have a financial plan. I think drafting up a will, that's the easy side of things, but even before or during that process, you have to sit with your financial advisor that also understand estate planning. You need to consider intelligent tax planning. I mean, we often see it, that unnecessary taxes are paid because people didn't take into account what are the estate duty implications. And I think it boils down to this, that if you have more cash available, you've got more money to invest, and if you add to that a layer of intelligent tax planning, then there's even more savings within your estate. And the more you save, the more there is for your heirs to actually benefit. And then, the last thing I do want to mention, that I think clients do not pay enough attention when they end up setting up trusts, and trusts often form quite a crucial part of estate planning, onshore and offshore. The letter of wishes that guides the trustees with regards to paying out capital and income of that trust when the settler has passed away, it needs to be very detailed. You do want to limit the access. If you've got young children or you've got young adults as beneficiaries. You really want them to be financially savvy by the time that they can benefit and request income and capital from the trustees, because that's the only way that you're going to ensure that there is a trust fund available for grandchildren and grandchildren's grandchildren. What we often see in our industry is that by the time that you get to the third generation, the trust fund has been depleted. And the way to avoid that is by having detailed guidelines in your letter of wishes as to how you would like the trustees to distribute benefit. We're not saying rule from the grave, but give enough guidance and express your wishes in such a way that there is a trust fund available for the grandchildren and the grandchildren's grandchildren.
That's very powerful, and I think it's often overlooked is how to manage expectations after you pass. And obviously, those letter of wishes have to be updated very regularly because things change so often in your own circumstances. They might become very financially savvy in a year's time, who knows? But maybe I'll ask you the last question that we ask all of our hosts and panelists. We should have called it the $1 million question a long time ago. But Coreen, if you were sitting there right now and you had R1 million end up in your bank account surplus to any requirements that you have now, how would you go about investing it?
All right, so I think what I'll do is I'll convert it to hard currency first of all, and I'll get it out of this country before the rand hits 18 or 19 against the dollar again. I think now is a good time to convert and get it out of the country. I'll put it in a conservo, and for those of you who don't know what a conservo is, it's a Guernsey International Retirement Plan. I think that will help me to save and not touch this money until I reach the age of 50. And I think when I get to 50, I will want to spoil it on Botox and fillers and whatever magic potion you can buy to stay young, and maybe I can be someone's sugar mommy, who knows? But yeah, I think that's what I'll do.
I did not expect that.
Perfect opportunity to get the conservo from Sovereign in there. But thanks a lot, Coreen. I mean, that was very insightful. A lot of things that are overlooked, and I think, as Alfonso mentioned, it's such a grueling conversation to have. It's something that's so avoided at all costs. I mean, I don't want to speak about it in my own personal circumstance, but it's very important to have these conversations, and it's so important to plan and make sure that everything's set up as soon as anything happens, that it's streamlined, succession is clean, and as you said, taxes are minimized. I mean, it's Alfonso and I always say that to our clients is when you start to bring down your tax liability, you don't have to hunt for that alpha return, or you can hunt for the alpha return and probably get even more after the net after tax return stuff. So thank you very much, Coreen. I really appreciate your time, and I really appreciate everyone coming on. Just like to finalize everything. I mean, we've gone through a bit of a journey here. It's been very insightful from my side. I mean, I've loved listening to all our panelists, and I've loved all the insight that's been given. And I think these type of things should be conveyed across a bit more, because again, the reason why Alfonso and I did set this up in the beginning was to give people a bit of perspective. I mean, we all get caught in our own bubbles about what fees we should be paying, where should we invest, what is the right thing to do. And I think these conversations that are probably not had around the braai that often should be spread around and said, what are you actually doing with your financial plan, etc. So thanks everyone for joining. Naturally, if anyone has any questions past our briefs or any of the things that we've done, please feel free to reach out to myself or Alfonso. We'd love to put you in touch with any of the panelists or hosts, or if you guys need some help with anything locally, offshore, Carrick and myself and Alfonso are very happy to help. So thanks everyone for taking part in our little journey, and I really hope the best for all of our listeners and all of our hosts and everyone involved. Thank you.
Thank you. Cheers.